Awesome. We're excited to have Rob with us and share some of his wisdom and experience. And we welcome any questions along the way. Just drop those into the chat, and we'll get them towards the end. And then also towards the end, we'll allow people just to come off mute and just ask the questions that you may have. So Rob, we'll turn it over to you.
Great. Well, good to meet everybody. I look forward to meeting more. I'm fortunate to have my associate here from Salt Lake, Ted Davis. Is there a feedback? Do you guys hear an echo?
I hear it too. So could everyone mute? We'll just have Rob be the only one on mute.
Yeah, that's better. Thank you. Um, yeah, so I'm based here in Seattle. Our company was started about 25 years ago, Escalon, in in Palo Alto, California. We're a nationwide company that provides outsourced resources, CFOs, accounting, taxes, HR, payroll, recruiting, pretty much all the back office needs that startups would need for for to help them scale. Um, I'm here in Seattle. I was blessed to meet Taylor Bench and his whole family actually on a boat cruise when they were up here in Seattle a couple of years ago. And then both Spencer and Taylor were up here for a family office group. Gosh, was that May? I think sometime in May when we
Yeah, it was
just seemed
June.
like it was last
Yeah,
month.
June, but time flies. The summer is.
Yeah, time flies. And so it was really great to connect. Spencer and I got the pleasure of getting to sit next to each other during dinner and got to connect and have connected since a few times. So it's great to be connected with these guys. Um, I just a little bit about me. I've done mostly business development over the years. Had a few startups that failed, which I learned a lot from and learned a lot of what not to do, which helped me in supporting startups the last 15 years, and really the last about 4 years with Escalon. I like to brag about my family. I've got two adult sons and I've got three grandchildren. My oldest granddaughter just turned 15 yesterday. So yeah, so I've got some experience there. I've got another thing that people talk about is I'm connected to about 30,000, got 30,000 followers on LinkedIn. So I leverage my network as a resource for clients, for friends, for partners. So as you're meeting me today, if there's any resources or people that I can connect you with, happy to do so. I'm going to go ahead and share now my deck. And I'm going to go ahead and I'm probably going to, because my bandwidth has been a little bit sticky, I might take myself off camera just while I'm doing this. Um, did the presentation show up? Okay, it's there. Um, so yeah, I want to talk about financial due diligence. And again, I'm really happy to have Ted Davis here, one of our senior CFOs, because he can help on the strategic questions you guys might have when we go in the Q&A portion of it. Um, and so with that, I guess how I'll start is, think about this. If you had $500,000 to invest in a startup that has no revenue, what would you want to see before writing that check? Most people would say, yeah, I want to believe in the founder, the vision, maybe even the product, and that's all true. But the reality is investors are betting on you as a founder, but they're also responsible for you to managing that risk. That's where financial due diligence comes in, even when there's no revenue. And so it still matters during pre-revenue. A lot of founders think, we don't have revenue yet. There's not much to show, but that's not true. Pre-revenue doesn't mean pre-responsibility. Investors want to see financial clarity. They're asking, do you understand where your money's going? Do you have a roadmap when you're going to need more money? Do you have control of your ownership structure? So these are all some of the questions that come up even at the earliest stages. Um, some of the common investor lack of confidence or common pitfalls that investors see are a lot of it has to do with lack of financial forecasting. one of the first things that shakes investor confidence is the lack of financial forecasting. Um, they know your numbers are going to change. That's not really the issue. What they want to see is that you've thought through all your costs, your growth assumptions, your revenue model. Without a forecast, they can't even evaluate a potential return. Another area or common pitfalls is unrealistic spending plans. It becomes a red flag, spending plans that are out of touch with reality. And I've seen those, and I know Ted's seen a number of those. If you're planning to spend like you already have Series A money, but you're still validating your MVP, it's reckless in how it looks to investors. Smart founders tie spending directly to their milestones, like product launch, customer acquisition, the infrastructure for scaling. That shows discipline to those that are looking to invest. And then another pitfall or can show lack of confidence for investors, unclear burn rate and runway. This is critical. If someone asks you what your burn rate is and you don't know, that's a problem. Investors want to know how much you're spending each month, how many months of cash you have left. That becomes your runway. If you don't have a clear handle on it, it signals poor planning and high risk. And then finally, one of the big pitfalls is a messy cap table. Um, the ownership of the company. A messy cap table is one of the biggest deal killers. And if you're given way too much equity or too early, or you've got a bunch of overlapping safes and with unclear terms, investors hesitate because they don't want to step into a governance nightmare. So it's important to keep your cap table clean, simple, and transparent from the beginning. Um, I mean, I I talked about all this and I didn't even move my slides. So let me see here. There we go. So let me go back. This slide here, which should have been up when I was sharing, talks about the idea of what investors' confidence is and what Instagram might show on a founder from the foundation of the company and what the reality is. And you can see the dilution in the different stages of investment. Now, this is assuming venture-backed capital. And so you can see how founder might think, hey, just 51% ownership when they get to Series A, but reality is it's more in the 30% range. Um, Let me move on because I'm going to move on to the next slide here. And by the way, if you guys send me an email or I can send this to Hannah, I can give you guys this slide deck so you don't have to take all these notes. I'll send them your way. Um, So here's some metrics that investors want to scrutinize during the early stage of startups. Investors not just buying into the vision, they're looking for signals of discipline, of financial discipline. They know the numbers are going to change, but what they want to see is how well you understand and manage your numbers. Um, let's walk through some of these key, financial metrics. First, investors want to understand your revenue potential. Even if you don't have much or any revenue right now or any traction, they'll look for indicators of how your business could scale. Um, they want to know your operating expenses and your discipline for spending. Uh, Not just how much you spend, but how thoughtfully you approach that spend. And every dollar should tie back to growth or critical operations. Um, Head count, contractors, payroll is usually the largest expense, whether it's, W-2 or contractors. Investors want to check your team size and your contractor usage and make sure they're realistic for the stage that you're in. Product development, are you overbuilding before validation? Are you allocated enough to hit your next product milestone? These are some of the questions they're going to ask or they're going to look for. Um, Sales and marketing spending. Are you spending smart to acquire customers? You pouring money into campaigns without a clear acquisition cost or ROI? And these are some other questions they're going to ask. And then General cost and administrative costs includes legal, office, facilities. You want to stay lean, obviously, in the early days, and heavy general and administrative costs before growth is a huge red flag for investors. And burn rate and cash runway, the amount of cash you spend each month. They want to know if it's sustainable and aligned with your milestones. And runway, how many months, do you have before running out of cash? If your runway is less than 12 months, you need to clearly explain your strategy for fundraising or your path to revenue. Obviously, if you got early traction, that's better because you can tie in that revenue to extending your runway. Um, and then they want to make sure that you are, tracking for there's a thing called Rose metric, which measures how much recurring revenue your company generates for every dollar invested in employee and contractor expenses. This includes wages, taxes, benefits, bonuses, commissions. So these are all the different things that they're going to want to track and talk about when they're thinking about investing in you. So here's some ideas and strategies for managing financial due diligence. Um, what happens when here's one of the questions that comes up is what happens when you don't raise a full round? You need to be clear and confident in your answer. And by the way, just so you know, in Seattle, we had a discussion recently about confidence in founders. Having these due diligence answers prepared and ready gives you way more confidence going into an investor meeting. But also, there's this thing that we've heard in the Seattle area that the founders in here are a little bit not as aggressive or confident in how they present to investors versus someone from the Bay Area. They seem to be a little more, or New York, a little more confident in going into that revenue or in that investment meeting. So these things will help you bring that confidence to those meetings. And so you have to have a clear and confident answer on what are we going to do? How are you going to prioritize those milestones and how to operate in a lean way? For example, if you raise 50% of the round, maybe you focus on building the MVP and then validating customer demand. If you raise 75%, maybe you expand into hiring some key sales roles. This shows investors that you're flexible, that you have an idea and plan as you're going into your investment round, and prepared to move forward regardless of the complete funding outcome that you've set as a goal. The other thing is operation expenses, forecasting that by each operating unit. Sales and marketing, how much to acquire and retain customers, how much you're going to spend there. Product and engineering, what resources are needed to build and maintain the product. And then, of course, the general and administrative costs like legal, facilities, HR, and other overhead. When you show expenses this way, it proves you're not just throwing numbers together. You understand where the money is going and why. And then cleaning up your cap table. This is a big deal. It's probably the number one thing that scares investors is a messy cap table. If the ownership's unclear, you've handed and like for example, you've handed out too much equity early, or if you stack too many convertible notes, it creates hesitation. Before fundraising, make sure that your ownership is clean and transparent. Founders still hold, meaningful equity. Any old agreements are documented and resolved. The investors need to know that governance and ownership won't become a future nightmare from a legal perspective. Sales and marketing expense, of course, we talked about that. How much is the per customer acquisition? How long it would take to recover that cost? Which channels will you test first? And then, of course, any concerns on the spend on the administration and general expenses. And then I'm going to close with this. Bottom line is pre-revenue startups need to pass the test of financial due diligence. Investors aren't looking for, they're really not looking for perfection. They're looking for clarity. As long as you make things clear, you have a really good shot at getting funded. They know the numbers are going to change. They want to see, discipline in the spend. Um, you want to have a model that actually changes with your cap table and with your revenue as you scale. So that's a good thing. That's one of the things we work on and our CFOs work on is building that revenue model. Um, and if you avoid most of these common red flags, you're not only build, investor confidence, but you'll build a stronger foundation. So these are foundational elements of your business. Yes, towards investment, but also just building a solid business. So pre-revenue doesn't mean pre-due diligence. Your financial discipline in your business today is really the signal of how strong of a leader in your leadership of the future of going forward with this capital raise. Um, and I guess I'll finish with that. I, uh, I know I dumped a lot. I'm just going to share a few other slides here that I'll send you. But these are some of the things that to consider in your business. So these are all elements, and there's tons more, obviously, but some of the key elements in your financial due diligence. If you have contractors, probably early on, you're not going to worry about HR so much, but you start preparing the way for when you do have to do your first hire. Making sure your tax requirements are taken care of. The Nexus study is good if you have to have one because that means you're doing revenue. If you're doing international, there's transfer pricing questions that come up. And obviously, the cost of technology is a big deal as well. And then finally, I wanted to give you my email address so you can reach me anytime. And just the next, three steps of for success are, prioritizing your financial hygiene before raising funds. So get that clear. Leverage CFO insights to align strategy and investor expectations. And this is why Escalon exists. And then continuing your financial oversight to build, lasting investor confidence. And with that, we can move to Q&A. So thank you for listening.
Thanks, Rob. Very informative. So there's a couple questions in the chat there. We'll just go kind of in order here. So Carmen asked if there's, and maybe this was back when you were talking about well, transparency. Is there such a thing as being too transparent with investors?
It's a great question. Ted, do you any thoughts on that? I have some thoughts, but I'll let you answer on that one.
And Ted, Ted, will you introduce yourself real quick too?
Yeah.
Sure. I'm happy to introduce myself. I'm a colleague of Rob. I'm a fractional chief financial officer at Escalon Services. And I came to this meeting today with the idea of assisting where prudent and needed with regard to these types of questions. My response to that question, Carmen, is yes, you can be too transparent. Just from the standpoint of involving business versus personal elements of how you started your startup, how you're working with certain problems, you want to keep it at a higher level and not necessarily involve your potential investors in all of your day-to-day situations and whether you have, you're certainly give them the truth, but certainly be prudent in that truth that you volunteer. Just from the standpoint of they want to have confidence in you and they want to have a situation where they can have the trust in that you'll be administering the funds and so forth in accordance with your stated objectives. That can certainly be overstated and certainly overdescribed and involve too many aspects of what would be relevant. So be careful. That's the one answer there. And does due diligence, I'll just take another one from Mariah Wang. Does due diligence look different for angels versus VCs? In a way, just remember the type of investing that you're looking for from angels is basically your startup round or your angel round, if you will. It's going to be just beyond the step that's friends and family that really gets you your first pretty good chunk. A lot of angel investors that I monitor and work with, their first check is $50,000, and then they'll go from there. They also may request that you be involved in some sort of an incubator program so they can monitor your progress and get to know you better during that process. The other thing that's important to note is that all during the process of startup, investors will be very interested in learning about and measuring what's traction for you. And of course, the whole process of that is to get you to critical mass. Critical mass means enough repetitive business and so forth to sustain yourself and be able to meet your obligations. So runway is very important, as Rob mentioned. Your burn rate and so forth are critical. Also, let me just comment on the back office. If you have a data room, and you should have a data room, which is your area where you collect all of your activity, all of your technology, all of your everything from your articles of incorporation to your financial model. Make sure that that is definitely reviewed and up to date as possible, because during the due diligence process, you're going to be called upon to talk about everything from the standpoint of contingencies. Are you involved in any lawsuits? Do you have competitors? Do you have the proper formation that's gone on with your corporation? Are you a Delaware C Corp? That'll be a common question, and some things of that nature. So make sure that your data room is absolutely complementary to your deck and to your due diligence presentation.
So we want the narrative to match the numbers.
Yes. The other thing about that is let me just interject something that's important as well. Is there's going to be a question early on of, do you have a financial model? And don't shy away from that. There are a number of ways to go ahead and achieve a financial model fairly early on in your process of capital formation, even if you're not an accountant or you don't necessarily feel like you want to bring in a CFO or something of that at this nature. There are a number of different providers, if you will. I'm speaking of Forecaster and some things of that nature, other people that basically assist in taking your Excel notes and things of that nature and turning it into an acceptable model presentation. Just make sure when you do that, that everything you're looking at is going to be verifiable, to at least to you, and at the outset, and then also make sure it's in accordance with the current generally accepted accounting principles, especially in the area of two places: revenue recognition, and don't avoid churn. Please remember that you've got to factor in churn. And then the second one is going to be, if you're going to be leasing a lot of assets, then make sure that you understand the leasing principles that are involved in right of use assets and things of that nature that have to be capitalized. Just don't think because you have a lease, you can basically write it off as a monthly expense. That is not the case anymore. Okay. So it hasn't been for a long time, actually, but a lot of people don't really understand the principles associated with leasing and how the disclosure requirements have changed especially over the last 4 years for private companies. So be aware of that.
Rob,
Thanks,
anything you
Rob.
want to add there?
No, I think
Okay.
it's exactly right. I think he gave an answer that I can't really add to.
Okay. Well, then we'll go down to the next one here. Does due diligence look, this is from Riot, does due diligence look different for angel versus VC?
You want me to take that one, Robert? Or do you want to take that?
No, go ahead.
Yes, remember the audience. VCs are basically going to be your first series rounds, and their intervention it can be okay in a late angel round. Typically, the VCs that I work with, they're looking at something between 3 million on up to 20, 30 million, something of that nature, which is clearly beyond the steps of angel investing. Angel investing is basically more along the lines of trying to prove up the concept, see those entities that are going to get traction early on, and which can get the sustainability and move to the next levels. There is a difference in terms of how you approach due diligence with that group versus a VC group. You're going to have much more sophistication with a VC group than you normally would. Although I'm going to say, if you have a top 10 list of things that you're supposed to prepare for a VC, the angel investors, I think, are going to probably get to 6 or 7 of those. Anyway, and one of them is essentially going to be your entity formation. your management background, your expertise, things of that nature, and whether you've got an accounting system set up right now, whether you've got a venture model that you put together, and all of the things that can sustain and support the description of what you give in your pitch deck with regard to your idea and your technology. Those are all going to be very important things for anybody taking a look at putting money into your company.
Yeah, there's a step up for sure between angel, then venture, and then even if you move on to private equity investors, there's a whole nother level of due diligence. The idea is having that foundational preparation done, that in your data room and all the things that Ted mentioned, having that done prepares you for each of these levels around. If you can get that done and maybe overkill for an angel, it gives them far more confidence than not having the preparation.
So maybe that leads into a question from Hayden. How do you know when it's time to bring in a CFO versus just using a part-time accountant? And maybe I'll just add to that, Ted, when you talked about financial systems or accounting systems, you know, when are you what serves at different stages in terms of an accounting system?
Well, I'm going to basically say that I've seen startups basically start with Excel spreadsheets. And there's nothing wrong with that because it's basically a sources and uses type documentation. You're saying this is what the money was that came in, and this is what it was for, and this is how I spent it. So it's just a regurgitation, if you will, of your bank statement, but it gives a lot more detail than your bank statement does. But the thing about it is that the language of business is going to be accounting. And so you need to dive in as early as you possibly can, maybe with an early subscription to QuickBooks Online or something of that nature. If there's a template or a specific industry that is going to be handled well by that. And don't forget the whole idea that if you're putting together a company that is designing and bringing to the table new technology, I'm talking about proprietary information, new technology, an app perhaps, new software. There is a point in that process when you stop doing R&D type work and you actually do completion work, and the accounting for that is completely different. R&D work is basically expenses incurred, but when you get to that economic feasibility point and the determination to complete your app, your project, your software, your pilot plant, whatever it might be, those costs from that point on are all capitalized, and they have to have an accounting system to plug into, or you're going to lose control because you won't be able to qualify for any tax credits that you might be looking for or things of that nature without that kind of documentation and information. So
Yeah.
don't shy away from an accounting system. They're fairly reasonable. I mean, you can get into QuickBooks Online at this point in time, I believe, for less than $100 a month. It's probably less than that, but it's just a necessary tool that you get into early on. Get in touch with a bookkeeper type individual, an accountant that literally can help you with the setup of the chart of accounts. I'm going to tell you that so many things that you're doing, you will do in the capital formation arena and moving forward with your company will depend upon the integrity of your chart of accounts. So don't overlook that. Please don't go with a alphabetic chart of accounts. It's got to be something that's actually set up and numbered so that it reflects clearly the idea of this is my R&D expense, this is my revenue categories, this is my operating expense category, this is my selling and marketing area, selling and marketing and sales and marketing type expenses, and then also your last category, second to last category, G&A, and then you have your other items, which is basically everything on down to your depreciation, your amortization, and your tax liabilities that have to be paid for. And you will have those, because even though you're incurring losses, don't think you're not going to have minimum tax obligations. If you're operating in California and other states, you're definitely going to have a minimum tax obligation, regardless of whether you have an income or not, net income or not. So that's why it's important to understand all of the elements that are associated with your accounting package, and then how to present all of that, wrap it up, and make it part of the information that you present in your deck. Okay, because obviously that's got to be one of the things they're going to be looking at. They're going to ask the question, Every investor that I've ever talked to, or angel, or anybody for that matter, have always said, send me a copy of your most recent financial statement. So
Yeah.
just plan on that.
Yeah, and I would add, this is a question that's asked quite a bit. Rob, what do I need? Like, what do I need right now? And oftentimes, if they have the finances, you can get financial packages down to $500 a month. Getting your chart of accounts set up, you got very few transactions, so we can get those things set up if you can afford that. A lot of times, people say, "Rob, I've got this amount of money. What do you recommend?" I recommend oftentimes a CFO consulting before you even, if you have money between accounting package and CFO consulting, I always lean on the CFO consulting because they're going to make sure your investment package, your due diligence, your data room, all that stuff is set up properly. We can always do cleanup on the accounting from the Excel spreadsheets and move them into a system, but and do a monthly GAAP, US GAAP accounting. But before you even get that, you need to raise capital, and a fractional CFO like Ted can help you with that.
Great. Arjun asked, what's the most common reason startups fail due diligence, the financial due diligence?
Well, for me, I've seen it's the cap table. A lot of it's the messy cap table. They have no idea. And probably the other one is financial model. There's gaps in it. It's not complete. It doesn't have all the elements that is needed. And Ted can go into his thoughts on those things.
Yeah, thank you. Yeah, financial modeling is definitely something that needs to live and breathe and evolve. I would also say that, from my experience, a company will fail to get traction, with their initial reach out for customer base. So they don't have the opportunity to really achieve critical mass. They're going to run out of money and fail. And so all along this process, remember that your investor group is going to be monitoring your traction. And that is your dedication to basically getting into the arena, making the idea, proving up your customer base, and that you have the ability to penetrate that particular aspect of the market ultimately. That is a very, very important aspect of it. Failure to do so will cause failure of your business.
Okay. Christian asked, oh, Christian, you want to come off mute? Just say hi and share your own question.
Yeah, sure. Thanks, guys. Yeah, just starting a new company from scratch, and I think we kind of addressed that. I was just wondering about the specific tools and, QuickBooks, Excel, those types of things. And when you kind of make that switch to kind of become more sophisticated in those tools.
Ted, do you want to answer that?
Uh, I'm sorry. Could you repeat the question again, Christian? I was focusing on another question on the
Well,
chat. So
here,
beg your pardon.
I'll take it first,
You'll
and you
take
can
it,
follow
Rob.
up.
Thanks.
Yeah,
Okay.
so I think QuickBooks Online is the best, bang for your buck early on. It's still 90% of our clients use it. At some point, depending on the type of products that they're selling, they may want to move into it, and obviously, usually in a later development of their scale, NetSuite, some go into Sage, and some other elements that they can leverage. And Ted can explain more of the why on that. But I think early on, and QuickBooks is still, I think, the king when it comes to early stage companies. And then you'll find out based on some of the new elements that are coming out in these programs like NetSuite that can benefit your organization. Those are far more costly. We've got contracts with them, so we're about 80% less than trying to buy it off the website. But usually you're a little bit further along before you need to move to those sophisticated systems.
Okay. Well, thanks. Perfect.
Yeah, there's another question in the chat box that said, should the financial model and forecast reflect your chart of accounts? Absolutely. Okay, the one thing that's going to happen during due diligence is your investor group or their attorneys or their accountants are going to go in and check out, what do your financial statements say, and where do you start in your financial model with that historical information? I would suggest you always take an opportunity to bring in the most recent year of your historical financial information into your financial model and then start from there. So if you're starting your activity to raise in 2025, have your historical information for 2024 tie out to your financial statements, put it in your model, and say, this is my starting point. And also, the other most important thing I'm going to tell you, and this is very, very important, and that is that project your model as you account. Okay, so yes, your chart of accounts does have a tremendous bearing on how you present your financial information in the model. You should be doing essentially an extension of how you would account for all these transactions and showing literally your ability to scale. Later rounds of capital formation are dedicated specifically to the idea of saying, this is money to grow. That's why Series A, C, ABC situations are so important when you're ready to get into that scaling activity. And then you have to make sure you can measure all of your assets, your head count, everything else, and say, yes, I'm capable of scaling, 50x, okay, if needed, okay, based on my opportunity to penetrate the market. So very important associations that you need to maintain between your chart of accounts and all of the other aspects of your financial statements and model.
Very good. Michael, thanks for sharing that. Okay, we got time for one more question. If you want to come off mute and just ask your question. Don't be shy. The awkward silence. I love it.
Okay.
The awkward pause.
Ted, and I don't know if it was Ted or Rob, you mentioned Forecaster. We've talked about QuickBooks. Today I was introduced to maybe a Forecaster competitor called Fathom. I know people are dropping spreadsheets into GPT and saying, act like my, early stage accountant. I think it's good. People are coming here and they're asking questions. I think the live, face to face, or Zoom to Zoom is probably the best. But what else are you guys seeing people do to especially in that bootstrap or just getting started, maybe as Christian's describing, pitfalls, things to avoid? Is it okay to drop your model into GPT and ask for some guidance? Garbage in, garbage out.
3, 2, 1. It's not fast, Leo.
Yeah, I think we got somebody off mute again. So
Yep.
Yeah.
John, if you could mute your iPhone,
Oh, yeah, you put it different.
or we can
Is
have
that John's iPhone?
Thanks, Hannah.
3, 2, 1.
There we go.
there you go. Yeah, Rob, do you have some comment on that? And then I'll follow up.
Yeah, I've never done that. I know there's people that use a lot of different systems. I know Forecaster and other ones, and I know there's some that take you into a whole nother system away from spreadsheets, which can be difficult for some investors or consultants to read into. So I don't know enough about the different systems to talk about it, but maybe you can, Ted, because you've seen a number of them.
Well, I've done some ERP work, which is really an advanced type accounting system. I mean, when you're talking about enterprise resources and things of that nature and how far they expand, and it's really those ERP systems are generally there for the purpose of allowing you to scale. You're beyond 100 or 1,000 or 10,000 transactions, which is really kind of the scope of QuickBooks Online. And you're into the idea that I'm going into the millions of dollars of revenue. I'm basically looking at revenue realization principles that are much more complex because I'm writing much more complex contracts at this point. And so, yeah, you're getting into the realm of where you're going to have a more agreeable sophistication to your accounting system that's going to have to be able to grow with you. You're talking about Sage, Acumatica, NetSuite, things of that those types of systems are basically for later on. When you're talking about QuickBooks Online and Zero, things of that nature, systems like that, then you're talking about situations where there's the flexibility to integrate with what you're doing. You have to have payroll, you have to have some sort of a revenue recognition model with the receivables and being able to bill, control your accounts payable, some sort of a fixed asset module that's going to give you the tracking that you need for your capital expenditures that are subject to depreciation and amortization. So beware of those particular kinds of features. It's a search for the specific type of features and functionality that you're going to need at the time. The other thing that's important to note is that don't shy away necessarily from a desktop version, because a desktop version can be much more robust if you need that, rather than an online version. The similarities are, I mean, the gap is still visible in some areas. It's being narrowed down, but online accounting systems definitely still have some catch up to do. I'll leave it at that.
Very good. Okay. Grateful to you, Rob, and to you, Ted, for coming and sharing some wisdom and helping us kind of orient ourselves and think through some of these things. Let's see, Rob, on your first slide, did you have contact info?
I think on my last slide, I didn't really put I just put my email address on my last slide.
Great. And then I found you both on LinkedIn, so I'm sure everyone can find you. So Rob's
Yeah.
up in the Seattle area, Ted's down here in Utah. So I would encourage everyone to get connected and schedule just a follow-up conversation and run through any questions that didn't come up today. And thanks everyone for joining us.
Yeah. It's great
Thank
seeing
you very
everybody.
much. Good to see you,
Hopefully,
Spencer.
hope to meet most of you again sometime.
All right.
All right. Thanks, Spencer. Appreciate it.
Thank you.
Thanks everyone.
All right.
See you
Bye.
guys
Bye-bye.
next week.